Good morning, ladies and gentlemen. Well, back from a 2-week holiday and interesting times that we live in. The risk dial is still mainly positive. We only have risk off in the monthly, which is 20%, but we're still in risk on in the daily and the weekly. We have a lot of volatility due to this Omicron wave and the reduction in growth prospects that we have as a result of it, which is reasonable. But I would argue that the volatility has gone too far. In any case, let's examine what the bonds and the yield curve are saying and where they are leading the risk markets. You will recall that I left you with the idea that 2s10s were, possibly the easiest trade out there, the one that was almost a no-brainer, that 2s10s would come in. And they've come in on Friday exactly to the level that I think is really pivotal, and that's around the 75 to 80 area. You can see here from this chart how we have basically returned to exactly where we were at the beginning of the year, and basically all this never happened. What happens now? I think the Fed will continue to drain and it will continue to, even if it's not even if it doesn't do it in an accelerated fashion like the market is expecting, I think the odds are that sometime by the middle of the year we are ready for hikes, and the 2s10s are somewhere around this 50 area. I would expect a few days of consolidation around here, like always happens. If we look at even at a monthly chart, you will see that this is exactly what happens in this 2s10s area, that we spend several months. So this is a monthly chart, so we spent a whole quarter bouncing off it here before it goes down and possibly gets down to these levels around in the 40s. But to me, the direction of travel is still down. It's still a sell the bounce market in the 2s10s. Of course, it's not just the 2s10s that are flattening. Everything is flattening. I did not expect this move in 5s30s, but nobody could expect really the Omicron variant. And here we are. We are basically going to levels that we have not seen since early 2020. And do we now go for a negative yield curve? I really can't see it. And I can't see it because the growth expectations might be lowered, and they lower them from 4.2 to 3.8. But the Omicron variant would have to be something very, very strong in terms of mortality and in terms of every other morbidity to make the market expect some kind of recession. Because let's face it, when these spreads go to negative, you are looking for a recession. This is, 2018, where you're looking for a recession when the Fed was taking away liquidity. Just because the Fed takes away liquidity, that is actually bullish, because it indicates that the market should be able to look after itself. Now, this is the 10s30s, and this one is also going to somewhere around here, 23 basis points. I'm not fighting it. It's just that I don't see the macro reasoning behind a negative yield curve at the moment, and therefore I prefer to stay in the 2s10s, which makes far more sense than the rest of the yield curve. But it's undeniable that every single tenure in the yield curve is flattening, the yield curve is flattening, and that is indicating stress in the market. People are buying longer duration because they want to be protected. If we look at how the market is pricing the short end, it's very obvious that the market does not think that the Fed can raise rates beyond 1.5%. So in 22, we are seeing the beginning of the rate rises. And by the middle of 23, we have rates at 1.5% completely flat. So you can see the yield is basically flat all the way from June to September 23, all the way out to the 25s, saying that, and this is the Fed funds rate, you're looking at Fed funds around in 23 around the 1% area, with 3-month LIBOR being around the 1.5% area. So this is what the market is saying. The market is saying the Fed in no way can hike rates beyond the 1.5% area. So Fed funds are going to be somewhere around 1 to 1.25%, and the 3-month area is going to be around 1.5%. If that is the what the money markets are saying, and they are correct, and I think they probably are, that is saying that structurally rates are going to remain low even in the US for a long time. What does that imply for the 2-year note? Well, it implies that the 2-year note should slowly drift towards the 1% area, maybe the 1.25% area, and just be on top of Fed funds. This does make sense because that would give you the 40 to 50 area in 2s, 10s that I'm ultimately looking for. So 2s, every time they dip, they are a decent buy. I think we're going to have a period of volatility around here, because I think it's just too simple to expect 2s to go higher in yield from here. Having achieved that 75 area in 2s, 10s, I think it's going to be a while before the 2-year note starts going again. And I think it's too simplistic to expect the Fed to give us the all clear to take the 2-year note higher. But if they do, we have a meeting on Wednesday next, we'll change our mind then. But I think it's just too simplistic to have that happen now before year end. The other 10-years are doing, well, not a lot. This is the 5-year note, and I kept on saying don't buy it until 116, and it's still basically 116. It spent 3 weeks going 5 to 10 basis points either side of 116. So basically what the 5s are telling you, nothing is going on in that 10-year. It's the 2s that are under pressure, the 5s, nothing. And then the curve pivots, and it's the 10s that are slightly offered. But again, I think they will remain in this range between 125-ish and 160. I don't see that the 10s are going to go outside of that. And the one that's actually taken all the pressure is the 30s. But unless the yield curve is going to go negative, this is the kind of level that you should be actually saying no to the 30s and actually abandoning them and probably putting the money to work in risk as opposed to the 30s. I just can't see if the Eurodollars are correct and you have rates, Fed fund rates between 1.25 and 3-month money around the 1.5 level, why would you want to be long unless you're going to have a huge recession? Why are you going to be long of 30s at 167? I just can't see it. It makes no sense. To me, it's more natural that the 30s come back, and this is TLT. This is just people afraid of some kind of an accident in risk. And it makes sense that people are afraid, but I think over the course of time, we're going to come back down towards this longer term trend. And I'm just not a buyer of this panic that we're going to have a huge Omicron wave and you want to protect yourself by being long of TLT. I just don't see why that's going to happen. I mean, it could happen, but at these yield levels, I think the risk reward is actually going the other way on panics rather than being long of TLT. Anything around the 158 to 160, I think buying put spreads in bonds, looking eventually for it to come back down into 140s makes more sense than anything else, given the shape of the yield curve and given what the expectations of the money markets are. Before I look at Europe, I want to have a look at the yield differential between the US and Europe. And here we are back down to 182 basis points, where, we have more or less been in 182 at an extreme throughout the year. That's interesting to me because if Europe can't decouple from the US, and that makes fundamental sense because let's face it, inflation is a global phenomenon. I don't think it's only going to happen in the US. It needs to happen throughout the world if it's going to happen. It makes sense that these two markets, with extremes either way, are going to remain more or less coupled at around 182. So I'm saying this as background because if then we start playing against the yield curve in Europe, then by implication, we have to be playing against the yield curve in the US. This is this is what I'm thinking in the background, and I really can't see the US against Europe going much higher than this 194 area. So we're talking about those yields being pretty much locked in lockstep over the course of the next few months. And if that is the case, that actually helps us to think differently about the US. If Europe can't do any better, then the US isn't going to do much better either. With that as background for what European rates are doing, it's very unlikely that while we don't have very precise information about Omicron and we can adjust growth expectations to a reasonable level, just because Goldman Sachs reduced them from 4.2 to 3.8, that doesn't mean anything. They can reduce them again to 3 in a week when they have more data. So basically, the yield curve in the in Europe is actually not going to do very much until we have very precise data. They keep on saying, Lagarde keeps on saying that it's very unlikely that they raise rates in 2022, and therefore this is the 2-year note, and it's basically trading in a 10 basis points range. At some stage, this is going to be a wonderful short, but it's not going to happen while without the certainty of what Omicron is going to bring. If we look at the 5s, it's more likely to trade around this 69-70 area, but I think the risk reward at those levels is all to the upside. Are they going to ease in Europe? I think it's very, very unlikely. So anything around this 70 area in the 5s becomes attractive longer term. I think it's going to take a while. I don't think you have to rush in this. It's probably going to happen in January that you need to get short of European bonds. If you look at the Bund, it's more likely to trade down here at 47, 48. And therefore, I really feel no urgency in doing anything in Europe. It just continues to spit people out. But I think this kind of move back up towards zero will be indicated next year. It's just that now is probably not the time to put anything on. France is the one that's probably clearest. If you have a look, it just keeps on trading beautifully between levels. And this -10, -11 level is very, very nice. And on a panic, this -23 level is very, very attractive for longer term moves back towards the positive. Over the past couple of weeks, the dollar has certainly entrenched its bullish stance. I think it's likely that we see it over the course of the next month or so up towards this 98.54 area. Yes, it keeps on bouncing off this very important 96.47, but I think it's just a question of it being overbought. I think if it cannot break 95.07 in the next couple of weeks, I think the path of least resistance in the early part of next year is definitely going to go to the upside and probably trade par again. And that is because there just seems to be very little reason to hold euros. The euro is being, their economy is being more affected by COVID, and the US is some sort of safe haven. People keep on buying it. People keep on buying the risk assets of the US. And therefore, it seems to me that the path of least resistance at the moment is back up towards par. I think that suits the Fed because, in a way, the FX market is doing its job for them, and they don't need to tighten quite as quickly. So I really don't see any reason to go and sell dollars at the moment. I think the buy the dip strategy is going to be the one that we should concentrate on. How does that translate to Euro USD? Well, I think it's becoming clear that 115.43 is your weekly level. As long as it stays below there, all the pressure is going to continue to be on the downside, and you're looking for this kind of level somewhere around the 110 area. So at the moment it's a 50-50. You wait, you hope for a rally to sell. It just doesn't seem that any kind of, there is really, as long as it stays below 115.43, there is absolutely no pressure on the euro to appreciate. Gold is basically driving people nuts. It's 1764, what do you want to do? And basically has been trading between 1764 and 1830 for an age, with spikes up towards 1881. And then, in 2 days it gives up everything. Now, why should that be? Well, bonds are, if I believe that bonds are still stuck in a range and you will get backups in 30s probably in January, then that is not supportive of gold. And if I don't see that the dollar is going to be significantly lower over the next 2 or 3 weeks before year end, then I can't really be bullish of gold. Neither of those two are supportive of it. Can it trade 1830 again? Absolutely. I mean, there's absolutely no reason why it shouldn't. But really, what this chart is saying, and what the macro background is saying, is that you should always wait in gold to get to an extreme and buy that. Where is that extreme? And you just leave a bid, and that extreme is here, is between 1710 and 1693. This is the value area in gold at the moment. When it gets there, you just leave a bid and you watch it come back. I really don't see that gold is going to be very effective as a hedge against anything over the course of the next couple of weeks. This was a very disappointing monthly candle in gold. It just basically, had every chance of doing something, and boom, basically the closes in gold are all below 1800 on a monthly basis. That has to tell you that this is not a really healthy market. Gold DBC is still in a downtrend. We are basically back where we were in July. So this is still not a bullish formation. I still expect this to come down. And if we look at DBC, actually, what have we done? We have, and let's not forget that DBC is mostly oil. We have only taken out all this excess against the 200-day moving average. We are still above the 200-day moving average. We're not even, I think we've filled in a whole load of gaps that we left on the upside, and now we've left, gaps up here. To me, DBC is going to hold in, because I think that risk is going to hold in. But this might be an early indicator that we will follow, because if oil now starts dumping again, and it gave no sign of it on Friday, then that might be bad for risk. But I somehow think that this market will hold in, and then in the new year start making new highs. On a weekly basis, I just cannot see that this is immediately bearish. I think as long as it holds these levels between 1950 and 1868 and 1841, that sets us up nicely for some time next year to trade back up to 2439. There is nothing that I'm looking at which is not saying that inflation is going to continue next year, and therefore I just can't see a sustained downtrend in oil and commodities. I wanted to start risk with volatility, and it was pretty obvious that one should not be short of it, simply because one did not, as soon as the Omicron thing came out, it was obvious not to be short of volatility, because people would want to hedge ahead of year end and the uncertainty that it would bring. It hasn't been that bad so far, because this is what happened in January of 21. We got to these levels and then we backed off. But what I am seeing is a definite pattern that we are beginning to make higher highs, aren't we? And these moving averages are all beginning to go, from the longest to the shortest. They're all beginning to turn up. Probably saying that for a good portion of next year, we are going to have higher volatility than normal. Just a word of warning, this is a market where you have to catch the levels that you trade volatility at very precisely. Otherwise, what happens to my 1x2s is what happens to you. You have to wait forever to extract any value. out of a trade, which should be trading, 50, 60 basis points better than it is. But that is, that's what happens in trading. Nothing is certain. So as long as we don't start breaking these 35, 36 areas, I think that we are probably going to get a dip over the next couple of weeks. And this does make sense in a way, because people are hedging ahead of the Fed. Once everyone is hedged ahead of the Fed, unless the Fed surprises, volatility is going to come off. And to me, volatility is likely to be sustained for the next 5 to 7 days, but then it's likely to come back off down into the 20s, and we should have a little bit of a Santa rally after the Fed meeting. Because once everyone is hedged, where's the market going to go? SPX had a tough week. This is the weekly chart. So basically last week we closed at 45.90, let's call it, and here we closed at 45.38, just above the 45.35 important level. What does that mean? I mean, what's that? We just over 1%. It's amazing how much less the market is coming off than volatility is going up, which indicates that people are hedging. Okay, so people are hedging. Once they're hedged, where's the market going to go? Well, probably, I really don't think that the market for the, unless we get some really bad news from Omicron, that the market can really get much or close a week below this 44, 47 moving average. That this is like the 10 EMA, that it basically stayed above all year. That has to be your line in the sand. Every time you can see, every time it's tried it, it's failed, and that has to be your buy the dip level. If we have a look at basically what the market has been doing on a daily basis, it's basically been going up and down on this lower Bollinger Band. So what happened? We went down to the lower Bollinger Band on the Omicron news. We've bounced around a little bit and keep on coming down. And this line is coming down about 15 to 20 ticks per day. So this kind of area is going to be my favorite over the next few days, to see if we can get into a bounce between 44.80 and 44.23 to get a bounce back up to this 45.36 area. I think this 45.36 area is going to be seen several times over the course of the next couple of weeks. And if we look at how orderly this really is, and this is what's surprising, that you get such a burst of volatility. Volatility is up 10 vols, and really the market is doing what? It's coming down in a very nice little channel, and it's really not coming down that much. So really 44.26 I think is going to be a very, very interesting level. And I think from 44.26 we get moves back up to 45.38. This is the market that's getting destroyed. It's anything that is not a prime, as it were. The Russell is the one that is, basically cannot keep up. Every time it rallies, there's sellers. And that is the market that really is going to give us the clue whereby whether SPX can remain in a range. If we start closing weekly below 210, 63, that was the previous lowest close on the week, then we probably are going to come all the way back down towards 175 area. And then, you will get a lot more sellers in SPX. But I want to give it the benefit of the doubt. I think, this is mostly Omicron and it's mostly overdone. And, we went from the upper end of the weekly Bollingers to the lower end. I just don't see that we have enough information to start thinking that the that the Omicron variant will coincide with the Fed tightening some more. We all know how sensitive the Fed is. If we get Omicron news, which is bearish, I think the Fed is going to leave the acceleration of the tapering well alone for December, and it's probably going to kick the can into January, and that should release another little wave of endorphins into the market to not make it go down. But I'm looking at the Russell, and that's the one that I think is going to lead us over the course of the next couple of weeks. For SPX to do much worse, and we saw the Russell, so basically what they're doing is they're selling the second tier, third tier, fourth tier, fifth tier stocks. But for the SPX to do significantly worse, NDX has to do significantly worse. And really, when you think about it, what has NDX done? I mean, on a 195-minute basis, it hasn't done very much. It was making new highs. It basically come back, and it still closed above the previous high. And yes, could we have little dips in here, but it just doesn't feel like we're about to collapse. It just doesn't have that feel. I think that it's going to hold. It's going to have little moves down to this 200 period moving average. Maybe fill this gap down here just below 15,000 and then rally back up to 15,500. So what I'm saying is that I just don't see these markets getting destroyed over the next couple of weeks. The other market that I will consider as a leading indicator is the Nikkei. If it now starts closing below 26,910 on a daily basis or 26,940 on a weekly basis, there's something wrong. Okay, it's as simple as that. If the market that's being supported by the Bank of Japan and endless liquidity, and where there is absolutely no talk of rate hikes or tightenings or taperings or whatever you like to call it, cannot hold in, then there is something wrong. So that is going to be a leading indicator to me. 26,940 on the weekly, 26,910 on the daily. Very, very important, I think. The levels in Europe are equally important. 3,986 and then 3,844 are the really, really important levels in the stocks, and here are the equivalent levels in the DAX, 14,760. I really don't think that we are past this kind of price action. Up, down, up, down, up, down for several days. I just don't see that we have enough information, or that enough information is going to be released over the course of the next 2 or 3 weeks for us to be able to decide that we need to accelerate a direction. What the market did over the past couple of weeks makes sense. It basically said, we have uncertainty. Let's take up volatility and let's sell off the market a little bit, and then we wait for news. For the next leg down to happen, we need to have some pretty bad news. And I think we are more likely to have a period like this over the course of the next couple of weeks rather than a trending period. And that is the same for everything, for SPX, for NDX. And really the only things that can change my mind are going to be a brutal move in the TF, i.e. in the Russell, and therefore a brutal move that is going to happen in NQ as well. Otherwise, SPX has to trade within a 1.5 to 2% range. Well, going into year end, and let's face it, we're very much going into year end now. I am very, very light on positions. As I told you, I closed the 2s10s on Friday. I'm still looking to sell any kind of bounce into the 90s in 2s10s. I really don't believe that 10s and 30s are entering a new trend. To me, they're in a range, and I think that at really good levels, one could even give it a call spread in terms of yields, and a put spread in terms of prices in futures. I will post some of those on the stream when we get there. I think Europe is, for the time being, is an avoid. I keep on trading the bubble from the short side when it gets to those levels that I mentioned, and it works for 2 or 3 days, and then it stops working. What that means is that it's a ranging market, and that you should not expect it to trend, but just, basically get in and get out. And that continues to be the case. SPX, I've given you, to me, 44.80 to 44.23 is the level from which it's going to bounce very hard back towards the 45.35 area. For that not to be the case, NQ and TF need to fall apart. And while this area holds 15,111 in NQ, I'm still going to give SPX the benefit of the doubt. In these, I'm just doing nothing. I really can't see the point before next year. And really, I really can't see why the market would do very much ahead of the Fed. I think we have. We've got, apart from make some more people panic into bad hedges, most of the people are hedged. The ones who aren't will get hedged over the course of next week or so. And after that, I think that the odds of a Santa rally from lower levels like 44.23 are actually very, very high. Thank you very much indeed, and tweet you on Monday.